Good morning. I'm bringing you the Tampa commercial real estate market as it stands today, August 7, 2026. The Tampa Bay region continues to attract capital and talent at a measured pace. While national headlines focus on rate policy and inflation, what matters most to investors is how those forces reshape opportunity on the ground. Today we're looking at the fundamentals driving Tampa's office, industrial, and mixed-use sectors. Let's begin. The broader economic backdrop shapes every transaction in Tampa. Inflation is running at 3.4% year-over-year, moderating, but still above the Federal Reserve's target. That matters because it affects both cap rates and tenant purchasing power. The Fed funds rate sits at 5.33. That's consequential. Higher rates compress valuations, particularly in stabilized, lower-yield product. 30-year mortgage rates are tracking at 6.82%, a figure that ripples through acquisition pricing across residential conversion deals and mixed-use development. Unemployment in this metro stands at 3.7%. That's tighter than the national average. Companies are still hiring. Let's anchor ourselves in the numbers. The 30-year mortgage rate of 6.82% is not a barrier to acquisition, it's a filter. Sponsors with strong equity positions and lease-locked cash flow are moving forward. Those dependent on leverage are tightening underwriting. In Tampa's case, that favors stabilized, occupied assets over repositioning plays. The federal funds rate at 5.33% tells us the Fed is holding. No imminent rate cuts are priced in. That means cap rates will likely remain range-bound, compressed by investor demand for yield in a stable rate environment. Unemployment at 3.7% is your leading indicator for office absorption. Three trends are reshaping Tampa's commercial landscape. First, flight to quality. Investors are gravitating toward Class A office, stabilized industrial, and mixed-use properties anchored by credit tenants. Class B and C product is suffering because refinance risk is elevated and tenant turnover is higher. Second, industrial diversification. Tampa's port activity is robust, but logistics operators are diversifying beyond port-adjacent land. They're targeting nodes closer to I-75 and I-275 corridors where last-mile economics work. Third, residential conversion. Tampa's market is moving at a deliberate pace. That's not weakness. That's maturation. The 30-year mortgage rate of 6.82%, the unemployment rate of 3.7%, and the 1,380 housing starts all point to a market operating within its capacity. If you're evaluating Tampa acquisitions, whether office repositioning, industrial land, or mixed-use development, the data here is your foundation. At RipplEffekt, we track the macro indicators and the ground-level execution. We know which submarkets are absorbing space, which landlords are improving terms, and which borrowers are securing favorable financing. That's intelligence. Visit us at RipplEffekt.com for the full intelligence brief.